Bull market, bear market. You've heard these terms thrown around a million times, right? They paint this picture of an epic struggle for control of our investments. But is the story really as simple as up is good, down is bad? Well, today we're going to dig into the data and uncover a hidden story about market recovery that might just change the way you look at everything. Okay, so first things first, let's make sure we're all on the same page. The definitions, courtesy of Fidelity, are pretty straightforward. A bull market, that's just a period of rising prices. Simple enough. The bear, though, he's a little more specific. It officially kicks off when a major market index drops at least 20% from a recent high. It's a clear line in the sand. So you've got the bull charging ahead and the bear trying to claw everything back down. Seems like a pretty even matchup. But is it really a fair fight? That's the question we're asking today. Because when you start to really look at the math, you realize the rules of this game are, well, they're a little skewed. All right, let's start with the story everyone thinks they know, the one the headline numbers scream at us. Because on the surface, if you just glance at stock market history, it looks overwhelmingly optimistic. It really is a tale of two very different tapes. First up, let's talk about endurance. How long do these things last? Well, historical data tells us the median bull market runs for about 42 months. That's 3.5 years of growth. And the bear market, just 19 months. So right out of the gate, the bulls have more than double the stamina. And it's not just about how long they last. It's about pure power. The median bull market sends prices soaring by a whopping 87%. The bear, on the other hand, only manages to claw back about 33%. It's pretty clear the gains have historically just dwarfed the losses. So if you stopped right here, the takeaway would be pretty obvious, wouldn't it? The bulls are stronger, they live longer, they always win in the end. And if this is the whole story, long-term investing would be the easiest thing in the world. But it is not the whole story. And this, right here, is where we get to the hidden and frankly much more important part of this whole conversation. There's this cruel, kind of unfair asymmetry in the math of investing. It's a simple truth that explains why recovering from a loss feels so much harder than the gains feel good. So, here's the killer math. Let's say you start with $100. You have an amazing run, a 100% gain that doubles your money to $200. You're feeling great. But now, to wipe out that entire gain, you don't need a 100% loss. Nope, a 50% drop from $200 puts you right back at 100. That is why losses are so incredibly damaging. It takes a much bigger percentage gain just to get back to even. And look, this isn't just some theory in a textbook. This has had very real, very painful consequences for people. As one investor on Reddit pointed out, this exact math is what created the lost decade. After the dot-com bubble burst back in 2000, it took over 6 years, 74 months, for the market to just hit the same number again. But if you were an actual person living through it and you account for inflation, it took over 12 years just to get your spending power back to where it was. 12 years to break even. Which brings us to it, the single most important variable in this entire story, the one factor that separates a painful but, recoverable dip from a decade-long nightmare, the one thing that turns a regular bear into a monster. And here's the big insight from a really deep analysis by Invesco. It's this: not all bear markets are the same, not even close. The dividing line, the absolute game changer, is whether or not that bear market happens at the same time as an economic recession. So what's the actual difference? Let's break it down. Your average bear market that happens without a recession, it drops about 27% and hits rock bottom in around 6.5 months. Annoying, but not catastrophic. But a bear that brings a recession along for the ride, whoa, that's a much deeper 43% average drop. And it takes over 15 months just to find the floor. It's deeper and it's a whole lot longer. But believe it or not, the fall isn't even the scariest part. This is the knockout punch. Just look at the difference on this chart. The climb back to your old peak from a non-recessionary bear takes on average about 19 months, a year and a half. You can handle that. But a recessionary bear, the average recovery time is 129 months. 129 months. Just let that sink in for a second. That is nearly 11 years. 11 years, not to get rich, not to make new money, just to get back to where you started. This one little variable, recession, changes the entire game. Okay, so what on earth are you supposed to do with that terrifying piece of information? The point isn't to run for the hills. The point is to be prepared. This isn't about learning how to predict the next recession. It's about building a strategy that can survive one when it comes. Because the huge takeaway here isn't to try and become some market timing genius. Trust me, that's a fool's errand. Instead, you use this knowledge to prepare your mindset and to structure your portfolio so that it's resilient no matter what kind of bear comes knocking at the door. So how do you actually build that resilience? It comes down to those classic discipline strategies you've heard about. Dollar cost averaging, that forces you to keep investing consistently even when it feels terrifying. Diversification, that's what makes sure one sector crashing doesn't sink your entire ship. Rebalancing keeps you on track. And maybe the biggest one of all, removing emotion. Knowing that a recovery could take a decade is exactly why you need a plan that you can stick to stop you from panicking and selling at the absolute worst possible moment. I mean, at the end of the day, panic selling is what turns a temporary on paper loss into a permanent real world financial disaster. As Fidelity puts it so well, until you actually click that sell button, your losses are just on paper. Sticking to your plan through that potential 11-year winter is what separates the successful long-term investors from pretty much everyone else. So let's wrap it up. Another bear market is coming. That's not a prediction, it's an inevitability. It's just part of the cycle. The real question this data forces us to ask ourselves is not if it will come, but what kind of bear it will be. Will it be a short-term pain, or will it be the kind that brings a long, brutal recessionary winter with it? And most importantly, are you prepared?